Introducing simple market signals. If you understand the basic meaning of green, yellow, and red, you can succeed with simple market signals. Yes, it is that easy. What is simple market signals? Simple market signals is a market-based proprietary model that measures U.S. stock market risk, systematic risk, and then generates risk-based color-coded signals based on that level of risk. Simple market signals is like risk radar for the U.S. stock market. High or rising risk usually means the market is going to fall. Low or falling risk usually means the market will start to rise. The signals are generated weekly on the overall U.S. stock market and all 11 major sectors of the S&P 500. Let me give you a little bit of background on simple market signals. This is a culmination of my life's work in the financial markets and trading. This took me over 20 years to develop, and like most things in life, this came together piece by piece, right? So, most things, if you're working on them, you get one piece, and then you add something else to it, and then you add something else to it, and that's how this happened. I created this for my own personal trading and investing, right? I wanted something that gave me an advantage, something that gave me clarity, something that gave me insight, and something that was repeatable. I needed a consistent system for determining market risk, and I couldn't find anything out there. That's why I had to develop this. So even with my background, guys, I needed this, okay? And so that's why I developed it. I had no idea initially about creating a business around this, but once I had this, once I started using it, I'm like, man, there's a lot of people that could benefit from this, and that's when I put together the infrastructure to bring this thing to market. So simple market signals is simple, it's easy, it's effective, and guys, it's very affordable. So who is simple market signals for? It's for novice investors, it's for experienced investors, it's for industry professionals. I have financial advisors that are using simple market signals to help run their practice, all right? It's for anybody that has an intermediate to long-term focus. This isn't for day traders. It might help them a little bit, but it's really not going to help day traders that much, okay? So it's for anybody that has an intermediate to long-term investment focus and people that want to employ both offense and defense with respect to their U.S. equity investments. Simple market signals is for people who are tired of losing money, tired of not making money in the markets. It's for people who are tired of not understanding the markets, right? And it's for people who believe that there has to be a better way. And it's for people who want an edge, want an advantage with respect to their trading and investing. It works with any type of an account. So it'll work with your 401k, your 403b, your IRAs, your other equity-based retirement plans like your SEP, Simple, whatever you may have at work. And of course, it's going to work in your non-qualified accounts, your trading accounts, okay, your other non-retirement accounts. It works with any type of an investment vehicle. So it'll help you with your mutual funds, your ETFs, your stocks, and it will even help in options trading. Now let's have a little fun with this, okay? Who is this not for? So if you're so rich that money doesn't matter to you, well, then this probably isn't going to help you too much, right? If somebody believes that the government will take care of them, well, they're probably not going to benefit much from simple market signals. If somebody believes that the economy drives the stock market, well, it's not going to help them there, right? If people don't invest in U.S. equities or they only invest in commodities like gold, silver, copper, oil, corn, soybeans, it's not going to help them. And if they only invest in art, automobiles, collectibles, diamonds, again, not going to help them there, right? And if somebody doesn't care if they make or lose money, they don't need simple market signals. And if they're not interested in building wealth, well, I mean, who's not interested in building wealth, right? But if somebody's not interested in building wealth, simple market signals is not for them. And it's also not for people that believe in the status quo. If they want to continue to invest the way investing has always been done, simple market signals will not help them, okay? But simple market signals is current, it's market-based, it's based on a proprietary multi-factor model. It's not based on opinions, forecast, guesswork, or lagging economic data. Let's take a look at the signals and do a signal overview here. So again, the signals are green, yellow, red. So when the signal is green, what this means is that risk in U.S. equities is low according to our proprietary model. Your biggest market gains are generally made when the signal is green. And when the signal is green, This is your best opportunity for profits in U.S. equities. And what this means within the model is that all internal measures within our proprietary model are in agreement. So they're all saying the same thing, that risk is low, and that's why the signal is green. And this is also your best risk-reward ratio signal, okay? So when the signal is green, that is by far your best risk-reward ratio signal. When the signal turns yellow, just like a stoplight, this means caution, all right? Now, in a yellow signal, what you can probably expect is sideways to slightly lower or higher price action within the overall market. Within the model, this means that several indicators in the model are showing signs of weakness. But there's some of the internal measures in the proprietary model are in disagreement. So some of the indicators in the model are more sensitive than others, right? So the more sensitive indicators will start to roll over first, hence the signal will go to yellow, but some of the longer trend signals still have not rolled over yet, okay? So within the model and the market, when the signal is yellow, this means there's uncertainty, there's lack of conviction, both in the markets and in the model. Now this is possibly, when the signal is yellow, it's possibly the beginning of a correction or downturn. It doesn't mean that the signal will go red, but generally, if it does, you start off with a green signal, then it turns yellow, and then it turns red. Now, sometimes it'll go green, yellow, green, so it'll go back to green after being yellow. But this is that transition period where the market's going to be sideways to slightly up or down. And again, the signal, I want you to understand, I want you to have realistic expectations. The signal will not pick the exact top, but when the market is topping and rolling over, the signal will be green, and then as the market starts to roll over, the signal will turn yellow, okay? But it will not pick the exact top. When the signal is red, what this means is that risk is high in U.S. equities according to our proprietary model. All internal measures in our model are in agreement. So just like when the signal is green, right, everything's go when it's green. Well, when it's red, it means that everything in the model is saying the same thing, and what you can expect is that the worst market declines, including bear markets, are going to happen when the signal is red. This is the most dangerous time and dangerous conditions to own equities in in the market when the signal is red. This is by far the worst risk-reward ratio signal. And just so you understand, the markets will bottom and start to rise when the signal is still red. Again, the signal will not pick the exact bottom. Okay, so I just want you to have realistic expectations of how this works. It's based on the philosophy, and it's a trading philosophy, of cut your losers and let your winners run. And guys, to make money in the markets going forward, you have to embrace this philosophy. Cut your losers, let your winners run. So how well does simple market signals work? Well, let's start off by looking at a buy and hold philosophy from 1999 through 2014. And what we can see here, and we're looking at a chart of the S&P 500, and so we're going to start off in the left-hand side of the chart there in 1999, and you can see the market start to rise up, and then we hit this blue line, which, by the way, if you look over to the right, you can see the scale. That's 1,500 on the S&P 500, so that's 1500 is the price level. And you can see here we hit 1,500 for the first time in the S&P 500 in the first quarter of, right around the end of the first quarter, beginning of the second quarter in 2000, and kind of played around in that area for a little while, but it didn't hold. And then we went into that 2000 through 02 downturn. Beginning of 03 is when we finally bottomed, and then the market started to rise again, and it took years to get back to where we were. And you can see here from 2000 through 07 that there was no money to be made underneath that 1,500 level, right? If somebody got in right here, they didn't make, and they were a buy and hold investor, they made absolutely no money, and it took years to get back to break even. Same exact thing happened during this time frame. 07, the markets peaked, started to roll over at the tail end of 07, fell all the way through 08, bottomed at during the first quarter, early second quarter of 09, and then again came back up, and finally we hit that 1,500 level again in January of 2013. So what I hope you're taking away from this is that it took, for a total of 12 years and 10 months, almost 13 years, guys, the markets went nowhere. We were trapped underneath that 1500, 1550 price level. You can see it over here to the right. Finally, in January, February of 2013, the markets finally broke above that 1500, 1550 level and started to rise, okay? So this is the problem with the buy and hold investment philosophy. Buy and hold investing over longer periods of time, you can lose an entire decade or more where you make absolutely no money. Now let's drill down on that 2000 through 03 time frame using simple market signals. Now understand that this is backtesting, okay, because I didn't have the model completed then, all right? The model finally came together in 2017, so I want you to understand this is backtesting, but in backtesting this is what would have happened, all right? Simple market signals would have been red for the majority of this downturn, all right? So now let's drill down on this and see what the numbers look like. So the signal would have went red on the S&P 500 at 1450, at the 1450 level, in September of 2000, and then the final signal, the final green signal, would have went green, right? The signal would have went green at 890 on the S&P 500 in April of 2003. So there was a total of 560 S&P 500 points in the red zone. That is a 38.62% loss. Now, if you lose 38.62%, it takes 62.92% to get back to break even. And again, you know that takes years. We've seen that, okay? It took years to just get back to 1500, 1550. So this, again, is the problem with losses, all right? So again, let's take a look at that same chart. So you can see here that during this time frame, the signal would have been red for the majority of that downturn. Now, let's really zero in here. Let's focus in on this time frame, because I want you to understand that there's what's called whipsaws that happen where the market tries to rally and the rally attempt fails. So that initial signal at that 1450 level was here, and you can see here, hopefully you can see where my cursor is, but as we fell down, the market tries to rally here and it didn't hold, all right? The signal would have went green there, and then a week later the rally attempt failed and we got a red signal, okay? And then the market fell again. The market tried to rally. We got a green signal there, if you can see the cursor. A few weeks later, the rally attempt failed. We got a red signal. The key here, and the way I use this, is I'm not invested when the signal's, I'm in cash when the signal is red. Okay, that's the way I design this. Now, if you're going to employ this, you have to figure out how you want to use it, but I would encourage you to at least minimize your equity exposure during the red signals. But assuming, like the way I use it, that I'm in cash when the signal's red, and then I get invested when the signal is green, you would take some small losses here, right? You get in the market, and then a few weeks later it fails, and it may fail at a slightly lower level, right? The red signal comes out at a slightly lower level than what the green signal was, so you may take a small loss there. Again, the same thing happens here. It goes green, goes red, and then you had another one of these whipsaws. Okay, these are called whipsaws, where you get in, and again, the rally attempt fails. This is just the way investing and trading works, okay? Then the final signal, the green signal, where the market finally went green and held, happened here, and then you can see that we took off, and to the right of the chart there, we started to climb out, all right? But this is what would have happened. Again, this is hypothetical. I went back and did the back testing on this, but I just want you to understand what I meant by the signal would have been red during the majority of the downturn, but there was a few failed rally attempts where the signal would have went green, and you potentially could have gotten in, and then within a week or two or so, maybe a month later, you would have had to get back out and perhaps taken a small loss. The point is, don't take big losses, okay? If you're going to be a successful investor and trader, you cannot take big losses. Take small losses, don't take big losses. Now, let's do the same thing and take a look at that 2007 through 2009 time frame using simple market signals. Again, we can see here that the signal would have been red, the weekly signal would have been red for the majority of this downturn, and the exact numbers on this, the signal would have went red at 1500 on the S&P in November of 07, and then the signal would have went green on the S&P 500 at 875 in April of 09. That means there was 625 S&P 500 points in the red zone. That is a 41.67% loss. If you lose 41.67%, it takes 71.43% gain to get back to break even. Guys, do you know how hard it is to make 71%? That takes years. It's really, really hard. Okay? So again, cut your losers, let your winners run. Cut your losses to keep your losses as small as possible if you want to be a successful investor, if you want to make money over time in the stock market. The whole key is to minimize your losses, maximize your gains. Okay? So again, we're looking at this same chart, so we can see the signal would have went red here and then would have went green there. Now again, let's kind of put it under the microscope, so to speak, and take a look. During this period of time, there was only one whipsaw. Okay, and in doing the back testing on this, the market fell so quickly during that 07 through 09 time frame that there was only one rally attempt that would have triggered a green signal. And then you can see here a week later, each one of these bars, these candlesticks is what these are called, is a week. Okay, it's representative of a week in the S&P 500. So this week the signal went green, and then this week the signal would have went red, and it would have stayed red through that entire time period. And then finally here you can see in the lower right hand corner of the chart where the two lines intersect, the signal would have went green there. Okay, so again, that's using simple market signals, and that's what would happen during that 2007 through 09 time frame. Now, let's take a look at something a little bit more recent. And again, I was using the model during this time frame. I've had it up and running since 2017. And so now let's take a look at the calendar year 2018, which was, again, another real tough year. But what I did here, just to make it easier to understand and see, is I just separated this out. Green and then the yellow and reds are together. I didn't separate those out, but just to give you an idea how this would have worked for you in 2018. You can see here that the signal was green and then went yellow here, and then this period here between the end of January through the beginning of June of 2018, the signal was either yellow or red. And then we got a kind of a short signal here just for a short period of time, a few weeks, where the signal was green in June, but the rally attempt failed and went back into yellow. It never did go completely green, so you can see here that sometimes it goes, it didn't go completely red, but you can see here that sometimes the signal will go green, yellow, green again, and then we got a green signal, okay? And then you can see that in October of 2018, about the first week or so of October, the signal again went yellow and then red. And so if you go and look up the returns for the calendar year 2018, you're going to find the market was down over 6%. But you can see here that if someone was invested just during the green periods, okay, you would have only been invested about 4 months of the year, but you would have had a positive return. So the way I use simple market signals, now you'll have to make up your own mind how you want to employ this, but the way I use it is I'm invested during the green periods, I'm in cash during the yellow and red periods, okay? But you can see here that you would have made money here, you would have made money during this green period, and then if you just would have avoided the yellow and reds, you would have actually made money in 2018, where people that were fully invested all year long actually lost money, okay? But there are times like this green period here where you could get in and out at around the same price, maybe even lose a little bit. And then the same thing on the yellows. You could sell out if indeed you sold out when the signal turned yellow, like I do, and then you could get back in when the signal turned green, and you might buy back in at a slightly higher price. That is a reality of using this system. That is a reality of, and really that's just the price you have to pay to cut your losses and let your winners run. There's going to be times where you're going to get these short signals where you might have to buy in at a slightly higher price, okay? Or you buy in and then you sell within a few days or a few weeks at a slightly lower price. That is just the reality of investing in this manner, all right? So let's summarize these charts. If you were to reduce or eliminate your equity exposure during the red signals, and then increase and maximize your equity exposure during the green signals, you would potentially lose less and potentially make more. So simple market signals helps you know when to play offense and defense, and it gives you the potential to lose less and make more. I can't guarantee that that's going to be your experience, but simple market signals will at least give you the potential to lose less and make more. Simple market signals will help you in both up and down markets. So let's take a look at what others are saying about simple market signals. We're going to start off with a gentleman. I'm just going to use his initials, HD. He's been a financial advisor in the Phoenix, Arizona area for over 20 years. HD says, I've been receiving simple market signals for some time now. I have found the information insightful. When the model went red in the last quarter, he wrote this a little while ago, it gave an excellent early warning. This model is a great tool that assists me in the protection of profits and the rebalancing of portfolios. So you can see here that how a financial advisor with over 20 years experience, a very successful guy, how he benefits from using simple market signals in his practice. Okay, but even if you're not a financial advisor, this stuff is so easy, guys. So whether you're investing on your own or working with a financial advisor, or you are a financial advisor, this will work for you. Now let's take a look at what Paul has to say about simple market signals. Paul is a university professor and a professional musician in the Grand Rapids, Michigan area. Paul says, simple market signals keeps me in the loop about what's happening in the market, so I have a better understanding about what is happening with my money and its growth. It's a very affordable and easy way to stay informed. And lastly, we have JC. JC is a former financial advisor and a business owner in the Detroit, Michigan area. JC says, simple market signals is a great investment tool, easy to understand and use to make investment decisions. How can you get simple market signals? You will want to subscribe. As a subscriber, you will receive a weekly emailed newsletter that includes the weekly proprietary signal on the overall U.S. stock market. You will also receive weekly signals on all 11 major sectors of the S&P 500, and you will receive weekly market commentary, which is both valuable and educational. And you will receive special midweek updates when warranted. The weekly emailed newsletter generally goes out on Saturdays, but anytime during the weekend it could go out. But if there is a midweek change in the major signals, I will send out a special midweek update, so you won't have to wait until the weekend to find out that the signal has changed. But guys, there's more. What if you could also easily know and understand the current direction of the trend in the U.S. stock market? Introducing the early bird indicator. The early bird indicator is a trend indicator that works side by side with simple market signals weekly signals. The early bird indicator is a weekly positive negative signal indicating the current direction of the trend in the U.S. stock market. Let me give you a little history on the early bird indicator. This took me over 7 years of research to figure this thing out. I tested numerous time frames, and the end result is that the early bird indicator stays positive during the bulk of most uptrends and is negative during the bulk of most downtrends. And as the old timers on Wall Street say, let the trend be your friend and don't fight the trend. So what if you could know and easily understand both the current level of risk and the direction of the trend in the U.S. stock market? Do you think that would help you with your investing and your trading? Absolutely it would. Now you'll have access to two powerful forces, simple market signals risk indicator and the early bird indicator, which is a trend indicator. But you are in total control of the implementation of all signals. We don't do the implementation of anything for you. We don't run money, okay? We send you the information. You have to decide how you're going to employ this information. You are in total control of the implementation of all signals. As a subscriber, you will get the weekly proprietary signal on the overall U.S. stock market that is easily a $97 per month value. I could sell that signal by itself for at least $97 a month and still provide a ton of value to the end user. You will also receive the weekly signals on all 11 major sectors of the S&P 500. Again, I could sell those signals for at least $97 per month just on those 11 signals. You will also receive the weekly positive negative signal on the early bird indicator. Again, the early bird indicator can be sold by itself for $97 a month. All right. You will also receive the weekly market commentary, which is both valuable and very educational. And guys, that's priceless. You're going to continue to learn week after week after week. You're going to continue to learn more and more about the market and about investing and trading. The total retail value of this is $291 or more per month. And I should be charging at least $29.99 per month for this. But I'm not even going to charge you $29.99 per month. You get everything for just $19.95 per month. That's less than 67 cents per day. A Simple Market Signals subscription is just $19.95 per month. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. You just go to simplemarketsignals.com, and I'll show you how easy it is to sign up. First thing I want you to do is you have to accept the cookies. Okay, it's standard these days, so you have to accept the cookies. Okay, so once you reach the home page and you've accepted the cookies, please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. Again, that's just due to international compliance regulations. So click here to get started, and this will take you to the product page. Takes, depending on the speed of your connection, takes just a few seconds to load up. And again, this just reiterates the product there and what you're going to get. Then you click on the Sign Up Now button, and that will take you to the checkout page. And once you're on the checkout page, fill in your first and last name. The company name is optional, and then your street address, the billing address, of course, for your credit card. So if it's a P.O. box, put that in there. And then use your, of course, town, state, zip, your phone, your email. Make sure the email's in there because, of course, it is an emailed newsletter, so we have to have that. And then make sure this box is still checked because that's how your email gets into the system. If that's unchecked, your email will not get into the system, okay? And then double check, make sure you've got one subscription. Make sure you haven't clicked that a couple times because if it says 2, you're going to get 2 subscriptions. So make sure that box or that number says 1. Make sure your recurring total is $19.95 per month. And again, your first 2 weeks are going to be free, so you can see that whatever the date is that you're subscribing, your first renewal is going to be 2 weeks after that date, okay? And then you're going to put in your credit card number, expiration date, and the 3-digit code. Go down here and make sure you read the privacy policy and then the terms and conditions. You would have to read and check that box and then hit the Sign Up Now button. And it is that simple to subscribe. So the whole process should probably take you 5 minutes or so. It's that easy. At Simple Market Signals, our goal is to make investing in the stock market less confusing, less intimidating, more efficient, and more profitable for the masses. If not Simple Market Signals, then what? If you don't subscribe to Simple Market Signals, how will you know the risk level in the market at any one point in time? How will you know the direction of the trend? How will you manage your risk? Simple Market Signals is an intelligent way to manage risk in today's market environment. And just ask yourself, do you think you're going to have more success investing with or without Simple Market Signals weekly signals and the early bird indicator weekly trend signal? More success with or without this information? What's your risk? Guys, from my perspective, your risk is in not subscribing, right? Your risk is in not knowing the current level of risk in the market at any given point in time. Your risk is in not knowing the direction of the trend. And if all this did was to help you reduce your losses in the next big downturn, wouldn't it be worth it? You've seen the math behind that. You know that if you lose 33%, it takes 50% to get back to break even. Okay? So if all this did, and it's going to do so much more for you than that, but if all this did was to help you reduce your losses in the next big downturn, wouldn't it be worth it? Again, Simple Market Signals subscription, it's $19.95 per month. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and I'm going to give you your first 2 weeks free. Let's recap what you're going to get. You will receive the weekly emailed newsletter, which includes the weekly proprietary signal on the overall U.S. stock market. You will also receive the weekly signals on all 11 major sectors of the S&P 500. You will also receive the weekly positive-negative signal for the earlybird indicator, which again is the trend indicator. You will also receive weekly market commentary, which is both valuable and very educational. You will also receive special midweek updates when warranted. So if there's a major signal change in the middle of the week, you will be notified. You won't have to wait until the weekend when the newsletter goes out to know that. You will get those special midweek updates. And you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. What else are you going to do for less than 67 cents per day that could have this type of an impact on your financial future? And all you have to do is go out to simplemarketsignals.com and subscribe.